Gold is moving, and the reason behind the latest surge may be far more important than a simple spike in demand. On August 19, 2026, gold reportedly jumped by more than $100 in just 90 minutes, climbing close to $4,500 per ounce. The immediate trigger was a new announcement from the US Treasury, but beneath the complicated financial language, investors saw something much bigger: possible stress in America's long-term bond market. So, what exactly happened? The Treasury expanded its buyback operations for longer-dated government bonds. Starting September 9 and continuing through November 4, the minimum size of each operation was increased from $2 billion to at least $4 billion. And this came only days after another major change. On August 13, the Treasury doubled the frequency of long-end bond buybacks from 2 operations to 4 per quarter, and increased total capacity from $30 billion to $38 billion. Why now? Just before the announcement, the 30-year Treasury yield reportedly reached 5.34%, its highest level in roughly 2 decades. That matters because higher yields mean higher borrowing costs. But there is another important question. Where is the Federal Reserve? While the Treasury is supporting the long end of the bond market, the Fed has remained relatively restrained. On August 13, the New York Fed announced 0 Treasury purchases between August 14 and September 14. This creates a problem. The Treasury can buy back longer-term debt, but it must finance those operations somehow. One method is issuing shorter-term debt. Debt originally issued at rates around 2.5% or 3% eventually matures and must be refinanced at much higher rates. Moving debt around may buy time, but it does not remove the underlying problem. This is why investors are watching September 15 so closely. The Fed's temporary Treasury purchase pause ends. If the bond market remains under pressure after that date, the next logical step could be greater Federal Reserve intervention. That could mean a return to large-scale bond purchases, better known as quantitative easing. In a more extreme scenario, policymakers could move toward yield curve control, where a central bank commits to buying bonds in whatever quantities are necessary to keep yields below a specific target. Gold does not pay interest. Its appeal is closely connected to real yields, which represent returns after accounting for inflation. When real yields rise, holding gold becomes less attractive because investors can earn stronger inflation-adjusted returns from government bonds. But when real yields fall, the opportunity cost of holding gold declines. If inflation remains elevated, while policymakers push interest rates and bond yields lower, real returns can shrink. That environment has historically made hard assets like gold more attractive. That may explain why gold reacted so violently to the Treasury announcement. Investors may not simply be responding to the buybacks themselves. They could be pricing in what those actions might eventually lead to: Federal Reserve intervention, renewed liquidity, and potentially another round of monetary expansion. If newly created liquidity begins flowing through the financial system, investors may look toward assets that are scarce or difficult to create, including commodities and precious metals. Of course, none of this guarantees that gold will continue rising in a straight line. Financial markets are volatile, and the Federal Reserve may choose a different path. But September 15 could become an important date. If the Fed resumes Treasury purchases or signals stronger support for the bond market, investors will be watching for signs that a new phase of monetary easing has begun. And if that happens, gold's explosive move may have been more than a one-day rally. It could have been the market moving early. Like, share, and subscribe to the channel for more videos about gold and the economy. And to learn more about protecting your future, visit Aurauvault.com. This video is for educational and informational purposes only and is not financial or investment advice. Carefully do your own research and consult qualified financial professionals before making investment decisions.